My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Now, may have looked like nothing day to you. Dow up 18 points, S&P advancing 0.28%, Nasdaq gaining 0.71%. But in fact, it was a big victory for the bulls. See, there are about a dozen weeks each year when we're in the heart of earnings season and the Wall Street analysts become powerful enough to control the action. This is one of those times. They've got an outside ability right now to move stocks, particularly tech stocks. And today, because of chatter about a possible break in the trade logjam with China, not to mention the fact that Britain and Iran didn't seem to be going war over this oil tanker, the bulls were able to push all sorts of stocks higher. I think it's important that you know how this works. Behind the scenes, I'm opening the curtain. So let me give you some solid examples of how the analysts were able to move some stocks and therefore the entire market. We're going to start with Micron, symbol MU. This commodity semiconductor stock has been tossed back and forth like a football ever since it peaked at $64 and change last May, for pulling all the way back to $28, where it bottomed in December. Now, when Micron reported last month, the company made some positive noises about the long term, not the short term, but the long term. And that was enough to send the stock into the stratosphere. It moved from 33 to 45. Big run. Then today, Goldman Sachs decided to call the bottom, whatever, in Micron's chips, and the stock had yet still one more leg higher as the buyers went nuts for it. Buy. And that's how it could rally another 3.7% today on top of its previous move. Micron is perhaps the most important semiconductor bellwether out there. Their DRAMs and flash chips go into nearly everything. This upgrade, which came out yesterday, was the talk of the town in the Hamptons of all places. I kid you not. People were jabbering about it, the quag market, for heaven's sake, in line. They say, hey, what do you think about that Goldman upgrade? Goldman's bullish call also included the semiconductor equipment makers like Applied Materials and then Cramer Fave Lam Research. Makes sense. If you really believe commodity chips are bottoming, then you recommend the capital equipment stocks. From there, the pin action caused the entire semiconductor cohort to run, including Texas Instruments, which, by the way, reports tomorrow. That's how big a call it was. This positive action, the semis could continue tomorrow if press reports are true about Apple's buying Intel's modem business to break away from Qualcomm's stranglehold. Any consolidation in this group is positive. But speaking of Apple, you know what was even bigger news? Katie Huberty over at Morgan Stanley made a bold call. 1 week before Apple reports earnings, 1 week, she publishes a piece suggesting that Apple has an attractive setup into earnings because, and I quote, investor sentiment remains negative despite improving iPhone and services data points, end quote. This is a gigantic call. Katie Huberty over at Morgan Stanley made a bold move of great significance. 1 week before Apple reports earnings, she publishes a piece suggesting that Apple has an attractive setup into earnings because, and I quote, investor sentiment remains negative despite improving iPhone and services data points, end quote. Holy cow, this is a gigantic call. Huberty is going totally against all conventional wisdom here. In fact, this very day, Tony Sacconaghi, he's the Sanford Bernstein Apple skeptic, published a note. It was a note explaining that the company could have weakness in the very same services division that she's excited about. Get this. Huberty believes this service is accelerated and could grow as fast as 16.7%. Sacconaghi thinks it will be more like 12.4%. And that is decelerating. Meanwhile, the consensus is right in the middle. Now, because of Huberty's call, Apple ran more than 2% today. And while that may not sound like much, remember, you're dealing with a $950 billion company here. She has raised the stakes. On top of that, she also raised her price target from 231 to 247. Price targets mean anything? Yes, it matters. It matters because Apple's currently trading at just over 207, nowhere near her previous $231 target. So why bother to raise another $16? Insult to injury? I don't know. Is it superfluous? No, not at all. It's a line in the sand. It's a statement saying, I know I'm right. You're wrong. I don't like to jinx one of my absolute favorite stocks of one of my absolute favorite companies, but Huberty's call really messes up with the setup. We hate it in Mad Money when stocks run into earnings. I'm already envisioning Tony Sacconaghi coming on air and saying, Oh, what I see, the services are weak. Apple's best days are behind it after the company reports. Even if Uber's right, the risk reward just got really bad. Let me give you another one. Amazon. Stock had a nice move today, in part because of a Deutsche Bank report saying that Amazon, and I quote, is in the sweet spot of slightly accelerating revenue, end quote. Oh, the analyst Lloyd Walmsley also expects some margin improvement. Oh, this is terrible. As soon as I read this thing, I said, darn it all. If you own Amazon, I can't think of a worse piece of research to come down the pike. Why? Because if anything, I fear that Amazon could report inline revenues and declining margins, given that management has repeatedly told us that they're in spending mode. After seeing the incredible pickup of Microsoft's cloud business, I'm very confident that Amazon Web Services will have a huge number. But I don't think that's enough to push the stock higher, especially not after today's positive research report. It's ratcheted the expectations, like Katie Huberty with Apple, too high. You know what actually now has a half-decent setup because of the analyst community? Alphabet, the parent of Google. This morning, Stephen Ju from Credit Suisse came out with a piece where he talks about how Alphabet's business could come in softer than expected. Oh, now I like this call. Ju's a bull. He's using a $1,400 target for this $1,139 stock. Remember, you want expectations to be as low as possible. So this reset is exactly what the bulls need. That said, Alphabet's been reporting weaker and weaker numbers, which is counterintuitive when you consider how much money the consumer product companies have been pouring into online advertising. If anything, there should be a re-acceleration of Alphabet's business. And if we got that, I think the stock would tack on $100 almost instantly. Look, I'd love to say all of this is inside baseball. I mean, it feels like it, right? Well, you have Katie Huberty, you never heard of her. This guy, Cowan, this, that. Well, listen to me. You don't need to think about whatever these analysts are actually saying. But to a certain extent, I've got to be sure you understand the context. If you like a company and you believe it's doing well, and you're comfortable both with the products as well as the financials, you're going to be fine. But the reaction of a stock to what we call the print will often depend on what it's done beforehand. And that comes down to these kinds of calls. If Katie Huberty hadn't drawn the so-called line in the sand on Apple, I feel much more comfortable telling you to buy it ahead of the quarter. Now, though, if Apple fails to raise estimates, if it doesn't talk up its services business, you'll find yourself on the wrong side of the trade. If the quarter's good, you've already borrowed some of that upside. If it's bad, even for one of my faves, look out below. One thing's for sure after this run. It would be a mistake to buy Apple going into the quarter unless you get a meaningful pullback beforehand. The gulf between the bulls and the bears is just too wide for us to game Apple. But the bottom line, long term, I say own Apple, don't trade it. If the quarter goes well, great. If not, I expect the stock will come down and you'll be able to buy some more into weakness, maybe at a much lower price. Much lower price than we got today. How about Jeff in California, please? Jeff.
Hey, Jim, repeat caller, big fan of the show.
Thank you for calling again. What's up?
I was doing some research on industrial gas companies. It looks like these are some of the best in basic materials because they have a oligopoly and a lot of pricing power. I was taking a look at Linde because it looks like they're one of the best.
They are the best.
How do I enter
you were
into
dead
this position?
Right. Jeff, I got to tell you, the merger should not have been allowed. There is so much price increases in this industrial gas business. You've got the best one. We recommended 180 after the mergers. I will reiterate right now that this stock has another 10% in it, no problem. Analysts have an outsized ability to move stocks, especially during earnings season. You need to know how this works. Peeling the curtain back. Pay attention to their calls. Weak expectations could create a nice setup. High expectations creates a bad setup. On Mad Money tonight, is it a go for Grocery Outlet? A few weeks after launching its IPO, I'm going to take a closer look. Plus, with back-to-school season just around the corner, I'm telling you which retailers to watch in tonight's Off the Charts. But first, I took a little trip today. They say money doesn't grow on trees, but that sure doesn't stop me from looking. Cal Tomei coming to us from the Home Depot in New Jersey.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.